There we go. Okay, thank you guys very much. I appreciate it. You guys ready to learn some really cool stuff? I hope I can add as much value as I can for you guys and really just try to pay it back and show everybody how to not get punched in the face like I did 1,000 times. So I quit my CPA firm job to go into real estate in 2006. I really didn't know what the heck I wanted to do. I just knew that I didn't want to do taxes and audit because it was the most boring thing on the planet to do, of course. And I hate paying the government money, so I obviously hated the tax side too. And at first I was like, should I start a bar? Should I do another CPA firm, or what the heck do I do to get out of this monotonous thing? And I remember like sitting there wanting to bang my head against the computer going, I just can't do this for 40 years. And I don't know if anybody, you guys are in that boat where you're just like, you grow a certain level as, a W-2 or working for somebody else, but then, having to, push yourself in a different way makes your learning curve like this. And especially leaving my CPA firm in 2006 to go into real estate and started flipping houses. All of a sudden I got an office at the World Trade Center in Long Beach on the 23rd floor, and I thought I was the shit. I really did. I was like, oh, I'm dope. We're flipping houses all over the place. This is no problem. And I didn't realize, and I'm sorry for cursing. Sorry, buddy. I grew up on 90s hip hop. There's nothing I can do about it. So every once in a while, my mom, my wife, my kids give me crap about it. So too, but it is what it is. So, so I quit in 2006. Thinking I was dope, thinking I was like, oh, we're flipping houses. I got my first deal under contract. I thought I was going to make 30 grand. I ended up making 20 grand, and because I did the math wrong, of course, and that was all off. And I thought I was a good business owner because my bookkeeping was done, because I was still a technician at the time doing accounting work, going, oh, as long as the books are done, I know exactly where I'm at. Didn't matter if we're losing money over here, but at least the books are done, right? And then we were flipping them so fast, and then all of a sudden the lending market stopped right after we bought like 35 houses with our capital and our private investor capital. And at that time, it was probably the worst thing in my mind that could ever happen to me, right? I had my whole ego was like, I got a 790 credit score. I've never missed a payment in my life. We're flipping houses all of a sudden. And then I'm like, oh, wow, I don't know crap. Like, I really didn't know what I was doing at the time, and took a massive punch in the face and had to swallow my ego. And it was probably one of the best things that ever happened to me, because at the end of the day, when you stand back up, you become really strong at that point. And I remember, thinking that I'd been through a lot because my father passed away when I was 26 years old, and I kept pushing myself because I told my dad, my little sister, which was 1 at the time, I'll take care of her. I'll make sure she's taken care of. I'll make sure the family's taken care of. And I had to step into that, that role as a father first thing, even though I wasn't a father yet. And what 26-year-old is really a good father at the end of the day, right? You're like, let me go drink and girls. That's all I care about right now, So, and at the end of the day, you become really strong when you face this different adversity. And that's not the only time I've had adversity. I had one of my best friends who was in my wedding steal like over $500,000 from us, and almost took us down, but it didn't, right? We just kept scraping and scrounging and pushing forward. And I still remember an instance where I lost about $50,000 on an apartment building, and I remember telling my wife, hey, put your hand on my chest. Like, I just lost a salary right now. Like, I can't believe I just lost 50 grand right now. This is crazy. And I remember the next morning waking up going, okay, forget it. I'm going to go and I'm going to figure out a way to make this back right now. How do I make this back? And I woke up and started focusing, and I found another deal that I put under contract for a 1031 exchange investor that needed another apartment building, and I ended up wholesaling it to them. And basically in 2 to 3 weeks, I made another $70,000 to make that money back. And a switch went off in my head that basically was like, oh, wait a minute, you got to focus, you got to have your head up. You can't be like negative situation mentally, right? You can't let yourself get in that position because your mind's not open to the opportunity that's going to be right in front of you if you're focused on that negative, right? You're not open up to all the things that are right in your face to be able to make that money right back. And now, if I take hits, I had a contractor steal a couple $100,000 from us about a year and a half ago, and I was able to just wipe it off my shoulders and be like, make more money, figure it out, work harder, do a different thing. And it sounds crazy because a couple $100,000 or even more is like a house. You know, you're like, this is crazy to lose that much money. But at the end of the day, it's a matter of your wins, right? And if you're not thinking big enough, you can't get there. And there's, you know, things, I tell you these stories because being an active operator like this, you're going to take hits. You're going to move forward and you're going to be like, damn, this is hard. Was this even worth the time, the effort? And sometimes it's not on the monetary basis, but it is on the knowledge basis. So realize that when you have these ebbs and flows, you're getting challenged when you can't find deals, or you can't get a deal sold, or the rehab's over, or the billion other things that are going to happen to you. Keep pushing through and realize that, hey, it's going to be worth it in the long run, because now because of the knowledge base I have, I've been able to create massive amounts of passive income streams in a ton of different ways through real estate and different strategies that we deploy. So I have a CPA license. I basically worked doing the tax and audit, like I mentioned. I also owned a property management company where we would manage all these properties in different markets, or primarily in the Memphis market. And if anybody of you guys know anything about property management, don't ever become a property manager. It's literally one of the hardest things you'll ever deal with. It's like very, very difficult to manage all of those different problems. Since I took a bath, and since that happened in 2008, we've flipped a little bit over 1,000 houses now. We have over 35 million now lent out to flippers in different markets around the country. I've raised a little bit over $150 million now for real estate transactions in the last 15 plus years since I've been doing this. And you know, it took me taking these losses to learn how to mitigate risk and how to protect investors' capital. When everything crashed and burned, I took out 200 grand on my credit cards to pay my investors back, and they all reinvested with me afterwards to be able to, once the market crashed and they realized what actually happened and that I took the hit for them, they reinvested with me over and over again at that point, right? And at that time, I was just like, oh my God, I can't let them lose their money. Of course, I wasn't thinking that, I'm going to have to take this bath. I just was like, no, they can't lose their money for this. And you realize very quickly the importance of protecting your investors' capital when you're investing in real estate. And at all costs, you want to protect the money, because they will be there to make you money long term, well after that one downturn or that one down deal is gone, okay? So let's see, it's still, I think I got to get closer. That's the problem here. Okay, so again, I do a lot of seller finance strategies. I invest a ton of different passive cash flow investments, from mobile home parks to self-storage to multifamily to debt, all different types of small businesses I invest in as well. Most of them are passive. I also act as an active operator on a lot of different projects too. Depends on what those projects are. So I am now pushing a lot more towards being a much more passive investor and getting away from active operations. I don't think I'll ever flip another house as long as I live. It's, Deborah, it's like really, brain damage sometimes, dealing with contractors and dealing with all the different people involved that, perform or don't perform, or the micromanagement you got to do sometimes. It's a lot of work and it's a grind. And there's a big difference between, active investing and being a passive investor. Now, you can actively find ways of being passive. I know that sounds a little crazy, but like there's ways to develop cash flow streams to where long term you can be passive. You can put in the work up front. I just developed a financial model for a fund where I'm going to get paid just for developing the model and structuring the deal and doing the research on the deal up front. I don't have to raise capital. I don't have to do any operations work. I don't have to do anything with that particular deal other than structuring the deal up front and doing the research on that deal to make sure it all came to fruition, and helping with the initial deck of that presentation and everything for my investors. So, and the people that I'm working with that are the active operators that are doing that deal. So there's a million ways, depending on what your skill sets are, to create passive cash flow. So don't limit yourself by your own capital when you're investing in these strategies. Capital is just one resource, just like Kirk was saying. It's one resource that you can utilize to be successful in real estate and to develop this cash flow. It doesn't need to be yours to be able to do that either. There's tips and tricks and strategies all over the place on how to effectively raise capital, and I even have some presentations on that. If you guys want my presentation on how to raise capital, you'll get my information at the end, and you guys can reach out and get that info. You can also find me at MatthewOwens.com, which you can't see at the bottom of the screen there. We do help a lot of investors with financial structuring, financial planning type strategies and things like that, and tax mitigation strategies, because it's inherent when you're investing in real estate. One of the biggest things passive cash flow investors want, they don't want to pay taxes. They want big tax benefits, right? They also want stability in cash flow. So there's a big difference between investing in real estate and investing in notes, for example, because of the positives for each one are a little different, right? Notes provide you a passive cash flow every single month or every quarter that comes in. The single family homes or multifamily or different real estate usually is a value add play that's a little bit less cash flow in the beginning until you add that value, but you also get big tax benefits and you build wealth, and you can build in your profits through effort that you're putting in that deal, whether you're rehabbing or adding value in other ways, okay? So the point of that is I don't want you to limit yourself by your own capital and stuff like that when you're investing in passive investments, because it is only just one tool that's needed for this, this stuff. So, okay, cash flow and wealth building strategies was one thing we're going to cover. And then the pros and cons of some of these strategies, because if you understand the different strategies, you'll be able to pick the right strategy for you based on what your skill sets are, what time you have, the resources you have, and things like that, okay? So big differences there. Building cash flow streams to build the time you want and the financial freedom in your life. How do you do this and really create that life you want, right? Like Kirk was talking a lot about the why, right? My why originally was, oh my God, I'm going to keep trading my time for money for the rest of my life, and I'm never going to be free. I'm going to be a slave to this job forever, and I'm going to be, 70 years old, 80 years old, and I'm not going to be free, right? And now that I have kids, it's how do I teach my kids the same thing, right? If I can't figure out how to be completely free myself, then how do I teach my kids how to be free too? They're going to be caught in that same rat race and things like that, right? That same mentality. You got to be thinking completely differently from a normal job here, okay? How to do your due diligence on these investments, really, really key. And then doing your due diligence on the operating partners that you want to invest with. So if you're really trying to be passive, you don't have to recreate the wheel. You don't have to do all the work yourself. You don't have to qualify for financing. You don't have to go and do operations work. You can just invest passively. But that means you better know how to do your homework on people, because there's a lot of really bad operators out there and a hell of a lot more criminals. So you need to make sure that you are able to do your homework, that the people that you're working with aren't full of crap, right? They're not just making the numbers look better for no reason to make you want to invest, right? That hey, that's not a conservative estimate, and that is, hey, in your financial model, did you go put rents going up at 5% every year, but then expenses are only going up at 2% to make the numbers look better, right? Understanding some of these ways of mitigating risk and doing your homework on operators is imperative to be actually successful at investing with other operators, because there's a lot of bad operating partners out there. There's a lot of very good ones, but you need to know how to point out the bad ones and understand what makes a good and bad operator. And if you don't know, ask somebody with more experience, right? I wouldn't say necessarily ask attorneys or CPAs and things like that. They're not necessarily financial experts that understand how to mitigate risk when it comes to real estate specifically. Those aren't the experts I'm talking about. It's the people that are in this room that have a significant amount of experience. Who was it that said they got destroyed in multifamily earlier? So it was Andy in the back. That's what it was. He was saying, hey, I'm just here to teach other people how to not do what I did wrong, right? So that's really the key, is going to those people and learning those lessons through them versus you learning it yourself. If I would have done this all over again, I would have got a mentor as fast as possible. Would have saved me tons of money long term. Mitigating risk when investing with other operators or doing your own deals. So there's some things that you should be doing, whether you're investing with others or on your own deals, that you should be focused on as well. And then, of course, the pros and cons of being passive versus an active investor. So there's benefits to both, and you should understand that to see which way you want to go. And many times you should be doing both. Both being passive and being an active investor is usually the best of both worlds, because you're building a significant amount of wealth over here being active, but then being passive over here, you're able to really have your money working for you consistently. That really builds that long-term wealth without having to do the work, because there's only so much bandwidth you can do personally yourself when you're investing, okay? And then mitigating taxes, another one of my favorite things in the world to do, is taxation is theft, and you'll see a slide about it later on. So developing cash flow streams inside your retirement accounts also is another strategy I deploy significantly that I highly recommend you guys do. The idea behind it is to develop the cash flow stream that's big enough for you to pull it out during retirement and live off of that cash flow, instead of what most financial planners tell you to do, which is build it up to X millions of dollars so that you die broke, because you got to spend it all as you die, or as you live until you die, and then you're basically dying broke and not leaving anything to your heirs, because they don't necessarily produce the investments they have typically don't produce enough cash flow for you to retire off of, or even beat inflation. So there's some obviously issues with that, right? Okay, and then let's see, building that cash flow you can actually count on is another strategy that you guys should really be focusing on too, to be able to say what's sustainable long term, right? What's going to be there forever money for you to be able to live off of. Okay, cash flow and real estate wealth building strategies. So what are some of the strategies you can implement? Right? Single family duplexes, short-term rentals, multifamilies, mobile home parks. These are all strategies that you can try to focus on and make money in a million different ways. And like I said, you don't have to be the active operator. You can invest with somebody else, or you can try to specialize in any one of these different methods and focus on those strategies. And there's pros and cons of each one of these different strategies that come up. So promissory notes too, and syndication investments and funds all have different pros and cons that you want to be understanding before you actually invest in them, to say, is that right for you guys to start in the very beginning, right? So now syndications are just, all they are is pooling investor capital together into one particular deal, right? Or multiple deals, depends on the situation, but they're pooling investor capital into one big fund that usually goes and buys an asset or buys a multifamily, and you have a bunch of limited partners and you have a bunch of general partners, and those general partners typically do all the work. They take on the debt, they do everything for you, so the limited partner does not have to do the work other than that due diligence up front that you should be doing on that deal in the first place in that operator, okay? So real estate, there's debt funds, there's businesses. I've invested in tons of different businesses through syndications. I've even run different syndication businesses in different ways. And then there's a bunch of different value add strategies here as well, from increasing that cash flow through reducing your expenses. So being a CPA on this, it's almost like an unfair advantage, because I can analyze a financial statement, understand where the fat is that I can trim off of this of those financials, and how do you analyze those and come up with strategies to reduce those expenses and strategies to increase that income in different ways. It's not just rents, right, that you're trying to reduce. You can go and dispute property taxes. You can go do tons of different strategies. We just went and bought a mobile home park in Topeka, Kansas. It's a 172 unit building that I brought capital in and also put my own money in, where we're adding 52 new units to empty slabs, rehabbing 26 of them, and we're ending up at about a 13.8 cap rate at our cost. And so if anybody understands, cap rates, it's incredible to get a 13.8 cap in this kind of a market. That puts us at about 60 to 50% cost to value, which mitigates risk of a potential down market. And I would highly recommend, when you're investing in these different strategies right now, you're looking at it based on the timing of this market, right? Where is that deal going to be in a couple of years from now when things change? Is it going to be a multifamily that a lot of people bought in 2022 and 2021 that are getting destroyed right now because the interest rates went through the roof, and they might be on short-term bridge debt, and now they're going to be sending them back to the bank. They invested at the wrong time of the wrong market. Now, nobody knew rates were going to rise at that point that quickly, but really, if they did, a lot of good operators were like, well, can this sustain an increase in interest rate by a couple percent? Can this sustain a 20% drop in rents if I needed to, or a 20% drop in market value if something negative was to happen like that? So you want to be looking at your investments like that and saying, how can I be risk adverse and mitigate risk with every investment decision that you're doing? And does it make sense right now in the timing of this market, okay? So you can add units like we talked about, and you can add different income streams here. You can find and analyze different opportunities. That's another way of making money, just finding the deal in the first place and getting it under contract. You don't have to do anything else. If you find a good deal and you're working with multiple operators that know how to take those down, you can just say, I found a deal, give me a percentage of the deal, and now you don't have to do anything or take any other risk or anything like that. You don't even have to qualify for the financing on that type of deal. You can be making money in so many different ways if you find the right resources, which, what Kurt was saying, the capital, the deal, the operating partners, the different people that are doing the work involved, the lenders. There's so many ways of just bringing resources together and making money in all these different ways, okay? You can actually go through also and perform these operations and be the property manager, be the asset manager. There's a million ways of actually making money and adding value to a particular deal to make money in real estate, okay? So asset management and property management I mentioned. You can do sales and marketing. You can go and understand, the deal and do the deal analysis on these deals. There's so many strategies to utilize to add cash flow streams to your portfolio without having to bring the money to the table, okay? So let's talk about some of the pros and cons of these different strategies so you can say, hey, is this right for you? Is this going to work for you based on that strategy in particular? There's some really big pros and cons, right? So the first thing is, let's talk about flipping, okay? I have major brain damage from flipping houses, especially flipping 1,000 of these things and out of state, dealing with contractors. I hate them, right? Is there any contractors in the room, by the way? So, okay, well, sorry. I hate most contractors. There you go. So how about attorneys and CPAs and anybody? Okay, good. I'll talk all the trash I want about attorneys right now. So, obviously, there's faster profits. It's usually short term, and you can get big chunks of capital from doing these types of deals, right? You get these cash infusions that consistently can come in as long as you can do volume. But there's some cons to it, too, that you want to be careful of, right? So in addition to that, it's less susceptible to market volatility. And I know that sounds a little crazy because you hear about a lot of people getting stuck at the wrong time of the market in flips. But if you're buying right, you're actually looking at what is that property going to be worth 6 months from now when I sell it, and you're building in enough buffer to be able to do that. The problem comes when people don't do that and they're in the wrong time of the market. Even during 2008 when everything crashed, yeah, during the liquidity crisis, some of these markets dropped by like 20%. California had some bloodbaths that occurred and things like that. But at the end of the day, a lot of them bounced back. And having a 5% drop in market value is a major crash if you're dealing with 1 year. It took from 2008 down to 2006 down to 2012 to get from top to bottom of that market. It was like a 6-year term to get all the way to the bottom there. So really, you do have a lot of time. And if you're in and out of these things in 6 months or 8 months, you're in a lot better position than just holding long term during a crash and letting it slowly crash, as long as you build enough buffer in there for that flip. Your capital is tied up, right, for a very short period of time, which makes it easier to raise money because investors like to put capital in for a shorter period of time than necessarily. It's much harder to raise money for a 5 or 7 year deal than it is for a 12-month or an 8-month deal. And another big benefit is that when the investor gets their money back after that flip, they're going to do it again with you because as soon as they get that money back, the trust is built at that point. They're able to come in and say, oh, wow, they got my money back. Let's do it again. You just made me X% return. I'm ready to go with that next one, as long as you didn't suck on that deal and, they're not scared of you now, which could happen and can happen, right? So there's usually a higher return on investment on the capital. So, and in this kind of a market, in the top of the market, people are like, oh, I'm good with an 8% profit margin. That profit margin can be gone in an instant, like massively gone. And people were doing that. Rehab overages, things like that can occur. Market volatility by 5% on the max scale. Time overages, theft. There's a million things that can go wrong on the deal. And so I would highly recommend when you're doing these types of deals on fix and flip that you're looking at a 15 to 20% margin or don't do the deal. It just is not worth all that stress to be able to do that. And if you're dealing with properties in the Midwest making 15%, you better bump that to 20 to 25% because, if if you're on a $100,000 deal making $15,000, that can be gone. The same rehab costs can cost you the same thing in a Midwest or the Southern market than it can here in California, maybe a little more here because labor costs and things like that that occur here, of course. There's not a whole lot you can do by living in communism out here in California. So easy to use other people's money, and there's a lower cost of entry into this versus multifamilies. You might be having to raise $5 million on a multifamily project or something like that versus a single family project. You might be looking at California like $500,000 or $700,000 or $1 million versus the Midwest or something like that. It might be 50 grand you need on a deal out there in one of these markets. Okay, so some of the cons, the cash can be sporadic. A lot of times I see flippers getting into trouble where they use their personal funds because they have rehab overages or time overages, or they forget to do the bucket system and put all your money for that deal, including rehab buffers, aside first, and separating your personal stuff and having 12 months of personal expenses set aside, money you should not be putting in yourself. If that money is not, if you don't have 12 months of personal living expenses set aside, you have no business putting your own capital into a flip deal or any other project. You should have that first as a backstop. If you don't have it, use someone else's money for it. Learn how to raise other people's money to do that instead of putting yourself and your bandwidth and your family at risk, which is real easy to do, especially if you start doing volume, right? It can be very difficult. Learning renovations and dialing in contractor issues. So this thing is huge. If you're just starting out, or even if you're experienced, doing a full walkthrough every time of your property, even with your inspector. Like, we get inspections before the rehab, and then we get inspections after the rehab, after it's finished. And in the beginning, I was doing walkthroughs with these contractors and as well as the inspectors to show me, what am I missing? What am I not seeing? What does this cost? What's the labor cost for this? You tell me X amount of light switches need to be put in. How long does that take, contractor? I want to know what the hourly rate that I'm having to pay them for that electrical work is, so that I can see, is that in line with industry standard, or are they ripping me off? Because contractors are going to make as much money as they can, and you want to make sure that you control the funds very well with those contractors, because they will break you at the end of the day. So you're still working for this income unless you figure out a system, right? This is active. This is not a passive. Flipping is not passive in any way, shape, or form, unless you're the private investor investing with somebody else, okay? So you might have those additional capital needs. So putting aside that extra money or having it available, if you're raising money from an investor and you're going, hey, this is my capital stack, this is what I need for this project, you better be putting that rehab buffer and that interest buffer in there too, because you don't want to go back to the investor and ask for more money. That's like the cardinal sin of investing. They're going to be scared of you after that, having to ask more money. And sometimes you still do, and it sucks to have to do that. But at the end of the day, it's hugely valuable to buffer yourself and have those renovation funds sitting there on the side, okay? Transaction costs are massively high. The taxes associated with these can be high. So it's not the most efficient way of investing, right? Is fixing and flipping. You might gain some equity, but it's not necessarily the most efficient, because you're having to deal with ins and outs of this stuff consistently on the transaction costs and sales costs and stuff like that can occur, along with the tax aspect of this, okay? So, you're also having to pay higher interest to investors and hard money lenders because of the construction risk that exists on these things, right? If you're buying a turnkey house that's already rented and everything, the financing is going to be normal financing, right? Right now, it's probably going to be around 6.75 to about 7.5 to 8%, depending on the lender you go to, if it's a debt service coverage lender or not, right? Hard money rates are going to be in the 12s. In California, I've seen it as low as 9, but I'm also seeing that bump up right now as well. It depends on how big of a project you're dealing with, because the lender is in it to make interest rate spreads and points on those deals. So if you're doing a small deal, you're going to have more points and more fees and more higher interest rate than that bigger deal, because they're making the same amount of money on that bigger deal in their interest rate spreads and their points than they are on that smaller deal. It's the same amount of work. So you got to be able to make sure that it's in line with the size of the deal, okay? So there's a ton of work with this. When we're flipping 10 houses plus a month, we're spending $150,000 a year on direct mail, pay-by-click marketing. There was a sales and marketing system that we had to have in place. You better be able to get out to that property same day to go meet with the homeowner on the ground, and you better be personable. You better be able to find ways of solving their problems, or you're not going to get the deal for the cost you need to get it for. If you can't solve that investor's or that homeowner's problem, or whoever the seller's problem is, then you're not going to get the price that you need. And if you think about the real math behind this, it's not just, I need to be at 75% of ARV minus rehab costs is my purchase price. The interest costs, the holding costs, the appraisals, the insurance, all of these other things add up massively in your cost structure, and it ends up being where you really got to be at purchase at like 50 cents on the dollar, depending on what that rehab is, in order to actually make that deal happen. So how do you do that? You have to be able to add value to them. Can you help them with moving? Can you mentally take them from this horrible negative credit card situation and drowning in debt into this situation where they have a rental, their rent is paid for 12 months, they have no credit card debt? You have to paint the vision for them to get that deal under contract correctly, right? Otherwise, it's not going to happen. It's like when you're raising money. What are all the pain points investors have? They want cash flow. They don't want to stress. They don't necessarily trust you to be able to, with their money. So how do you go through and mitigate that stress and mitigate that risk in their mind by showing them how to do the due diligence on you, showing them how to do the due diligence on the deal and how the risk is mitigated in every possible way that you can think of on that deal, and teaching them how you mitigate that risk is massive for being able to raise the capital for these deals, including being personable. You know, I'm a CPA. It was hard for me to come out of my shell in the beginning, right? And I had two partners that were computer programmers and electrical engineers in the beginning. That's a tough sell, right? You're an electrical engineer. You know, you normally are not known as, just like CPAs, for having crazy personality, right? You know, you're the numbers person, you're the by the book person. You know, it's hard to do that, and you have to be able to talk to people in this game, or you're not going to be able to raise the money. And what's funny is you have to not need the money in order to raise the money too, because people will feel it on you when you need the money to be able to raise. Like you'll see it and feel it with regard to that conversation, and you feel the energy on the other people in the room when you need to raise that money. Okay, now let's talk about holding. Okay, so it provides that inflation hedge, and there's less work because of that back-end process, right? So you're not having to do the whole back-end process of this thing and the sales side of this. But, you know, you also get this inflation hedge, especially when there's inflation and you have debt on the property. Right now, property values could be going up at 5% or so, but inflation could be at 10. If you look at shadow stats, it's more like 15% as far as real inflation right now. And so what's happening, though, is that means your purchasing power is getting less and less because your property value is going up at a lesser pace than inflation. But if you have debt on that property, it's getting decimated with inflation as well, and you're building wealth at a much faster pace by having debt on there in the first place, right? So really, really something to think about, where in this economy, when you are going to have massive inflation, I believe there'll be a lot more in the future, you know, holding debt, the debt is the asset in the first place, not necessarily the property, right? So now rents can rise as well with inflation as long as affordability is still decent and wages catch up. But a lot of times wages take a while to catch up with that inflation to then increase those rents, okay? So it can actually provide that annual cash flow if it's done correctly, but it can be sporadic, right? You have a tenant move out, you have repairs, you have, you know, tenant termites, toilets, all these headaches that go with the asset. You know, sometimes it might take a renovation to get started and then it starts cash flowing, right? In the beginning, it might only cash flow $100 or a couple $100 a month even, and then 5 years later, it's going to be cash flowing $500, $600, $700 a month or more, and or higher if you're dealing with California numbers, you know. So and so realize that in the beginning it can be much more volatile until rents rise and you're really building that difference. Okay, so exponential growth through that leverage of inflation on the debt is what I just mentioned. Obviously, the tax benefits are huge. Okay, absolutely huge. Who has heard about cost segregation or bonus depreciation? Okay, awesome. For those of you who haven't, all you're doing is buying a property, breaking up the cost of the building into a bunch of little pieces, like the carpet's this, the lighting is this, the electrical panels are worth this much, and you're turning them into 5-year depreciable property and 7-year depreciable property, or 15, instead of 27.5-year or 39-year depreciable property. When you turn it into 5 and 7 and 15 years, you can do bonus depreciation and front load that tax benefit into year one. A year and a half ago, in 2022, I invested $600,000 into mobile home parks and got a $600,000 year one tax deduction for doing that. So I didn't pay taxes that year at all, which was awesome, you know? So you do these strategies and you do them every year, and you can really mitigate taxes and compound your wealth massively this way. Okay, now the cons of holding, okay? Well, actually one of the other benefits, which is huge, if you buy right, you don't have to sell. It doesn't really matter what's happening with values going up and down. If you're still cash flowing, then it doesn't really matter what's happening on a short-term basis. What matters is the long-term associated with this to build that wealth, okay? So it can, in a single family house, it can take a while to build this cash flow stream, right? It can be, you know, years before you're actually developing enough cash flow to retire off of on a single family home, unless you're buying all cash or, you know, utilizing other investors' capital and doing massive amounts of volume here, right? On this side, we were doing a lot of joint ventures with investors where we'd sell it to our investors at our cost. They'd go put 20% down and get a bank loan, and we would get 25% of the net cash flow afterwards for selling it at our cost, and 25% of the profits on the back end via a joint venture agreement. So we were doing that for years. I have tons of properties now just from that strategy where I'm taking advantage of other people's credit, other people's down payment, just by providing a discounted property to them and bringing equity to the table. It's a great strategy to utilize long term. At the same time, you got to do business with the right people, because there's some crazy ass people out there you don't want to partner with. Definitely do your homework on the people you're partnering with, because you know, you never know what can happen. People pass away on you. People have divorces. People, they're not crazy for passing away, but you know, but you get what I'm saying. Things happen in people's lives, and you want to protect yourself and make sure it's legally documented. You have liens against the property too, so they can't just go sell it behind your back, or you know, some crazy, you know, people out there. So be careful with that. A lot of preventative maintenance. Can be very management intensive. Who owns more than like a couple of rental properties, like 5 or more? So you guys know, you got to manage the managers. You got to be on their ass consistently saying, hey, my lease is coming up in 3 months. I just researched the market rents. I think we should bump it up, you know, a couple $100 or to this market rents. Or, you know, hey, you know what? I need you guys to do an annual inspection so I know what preventative maintenance is happening on this asset, that I need to make sure all systems are good still, that I'm not having some major expense that I just don't know about, right? So there's some major asset management that you have to do whenever you own real estate, of course, right? There's obviously liability, and, you know, the lending can be a little bit of a headache, right, to qualify for. You got Fannie Mae, Freddie Mac financing that you're qualifying you based on your own income, right? And they also have debt service coverage ratio loans that base it off of the cash flow that that asset produces. So if it's already rented, you're not qualifying personally. Now the property is qualifying, just like a multifamily deal is, but you can get 30-year fixed rate financing. It's usually a little bit higher of a cost of capital than Fannie Freddie financing, but you can get unlimited directly to your LLC. They don't even want to lend to you personally. They lend to the LLC, and we actually do this in-house. As a shout out, Todd helps me a ton with this stuff, and we do that in-house. So not to toot our own horn here, I don't really care that much. It's just kind of an interesting additional income stream that we built for doing this, because we lend capital to flippers all over the country. And so I don't lend in California, I lend in these other markets, but you can actually go through and we turn that into the long-term financing too. So it works out pretty well. So okay, and then obviously the risk of damage, theft, and perils and things like that. There's some crazy stuff that can happen with these risks. We had a property that we bought, renovated. It was on a busy street, bought and renovated, went to go get the occupancy inspection with the city, and they said, oh, it was vacant for over 3 months. Therefore, it's not grandfathered in as residential anymore. Now it's commercial. And we're like, what do you mean it's commercial? How do we get it back to residential? We just finished the rehab. There was nothing on any of the county records or anything that said it was commercial in any way. They said, oh, you got to go take it off a septic tank and go put it and connect the city sewer. We're like, okay, cool. Maybe it's a $20,000 cost or something like that, you know. And we realized, oh, wow, the plumbing line is across a 5-lane street and down the street 5 houses to connect to it, and we couldn't shut down the street to open up, the line because of the military base next door. We would have had shut down the only entrance into the military base, and so we had to burrow underneath a 5-lane street and down the street 5 houses, which was like, ended up being like $50,000. The house was worth like 180, and we're upside down on it, of course, and we're like, this is just ridiculous, and I know for a fact that the owner that sold it to us knew about this and didn't say anything, but for a $50,000 lawsuit, it's usually not worth it. You're going to spend that money for the hope that you get something with probably a 5% chance of actually getting something in the first place. And it's never worth your life of suing somebody. I learned that the hard way, just being like, no, this is BS. I'm going to sue them because of this, because they stole money from us. And then you never get anything. It's like going after tenants. Maybe you'll get $50 a month for the rest of your life from someone that does collections. It doesn't really make a lot of sense. So you also got the management of the taxes, insurance, and things like that, of course. Now, multifamily is a different animal, right? There's some other benefits associated with this. You have major value add potential. You can increase rents, decrease expenses, do landscaping, and do efficiencies on the outside of the building. There's a bunch of ways to increase the value of a multifamily asset, to exponentially increase that value of that asset, right? So if you're able to go through and increase, a 100-unit building by $100 a month each, that's a major, major value add if you're talking about being like at a 6 cap or a 7 cap on market value. It can be huge, and in California, a 4 cap, but maybe not anymore with the rates. So, obviously what I really like too is I find that there's a little bit higher level of sophistication with your partners involved here. When you're dealing with single family property managers, they don't make a lot, right? If they're renting out in the Midwest for $1,500 and they're making 10%, they're making $150 a month. They don't really care about you too much, right? It's not the end of the world if you said, thanks, I'm taking my properties elsewhere. On a multifamily, you got a lot more income there and a lot more efficiencies from these property managers that want to make money, right? Same thing with the lenders and things like that. They make more money on those types of transactions. And so I find it's a little bit better sophistication level on those. It builds wealth massively through inflation of rents, just like a single family can as well, but much more on a multifamily. And it does provide a lot more cash flow than single families do. This can be scalable, where you're maybe in the beginning of a multifamily, you're now going to make $5,000 a month or something like that, instead of making $100 a month or a couple $100 a month on a single family asset. So it can be much more scalable to get out of your job faster. So why wouldn't you go, and if you don't have the money yourself, go raise the money from investors, even if it's more money, to do one of those deals, because you're going to get to your goals a lot faster doing that. I wish I would have learned that before flipping 1,000 of these stupid houses, at the end of the day. Now, I'd much rather deal with the mobile home parks and stuff like that are scalable on that level. So exponential growth, the same thing I talked about with that inflation with the debt as well. And then the depreciation and tax benefits and things like that as well are massive. And then it's the same thing, you don't have to sell the building right away unless you are trying to refinance in 2024 and 2025 and 6, when the rates are much higher than they were. And you're going to see a bloodbath coming, in my opinion, in multifamily for at least a year or two, unless rates come down, because there's so many multifamily assets that are needing to be refinanced in the next few years, at the same time that the banks took a liquidity hit over the last year. When you're seeing some of these banking crises and things like that occur, I really think that there's a lot less lenders out there that want to lend, and they're lower loan to values, making sure that if rents drop, they're at much better debt service coverage ratio levels, meaning they're going to finance less of your building than they normally would have before. Okay. And cash flow can be considerate to be able to, or significant to cover your monthly needs. And you can also make money in upfront acquisition fees and asset management fees. So a lot of times people are like, great, I can go buy this multifamily building, but there's usually a preferred return involved, right? Investors make X amount return first. Maybe they make 7 or 6 or 8% on their money first. Then there's a split with the operator. So their operator's sitting over here going, oh crap, how do I live while I'm doing all this work for this to manage this building. And so they're buying bigger buildings and they're charging usually a couple % asset under management fee for all the work that they do up front for that acquisition fee, and a couple % asset management after that on an ongoing basis, which keeps the lights on, right? For the amount of work that they're doing, it keeps the lights on. If you see it above those levels, you start seeing 3-4% asset management fees and acquisition fees that are much higher than that, or it's one-sided where the operator is making a bunch of money up front and less money on the back, that's a red flag. You want them making money with you and not off of you up front on these types of deals, okay? So some of the cons, okay? Capital needs are real scary, right? All of a sudden you might have to raise $5 million for a deal instead of, $500,000 for a deal, right? The financing can be much more difficult as well, especially if you don't have experience. These different banks want you to be able to be successful at this. And so if you don't have experience or you don't have team members that are experienced, they may not lend you the money just for that reason alone, right? They're going to say, no, you're going to screw this up. You're a brand new investor, not going to lend you the money for this, right? For that particular reason. And I don't like the terms of the multifamily side as well. So less favorable terms than single family. You're not, unless you're doing Fannie Freddie or a HUD loan, you're not getting, a 30-year fixed rate term. Most Fannie Freddie loans for this are 10-year terms or 7-year terms on big commercial multifamily type deals or self-storage or mobile homes. And so there's usually a balloon at the end. And a lot of banks don't want to give you even those long terms right now because they don't want to take the financing risk, right? They don't want to take the risk of interest rates rising in the future further, and then they're stuck holding the bag over here with a lower rate, right? So all things to consider. The mistakes are amplified. If you forget AC units, you might have 100 AC units now that you forgot about, right? Or if you forget the water heater, that's a big expense times however many units you have. So you really want to have an experienced operator on your team working with you, if you don't have the experience yourself, to mitigate some of these risks and make sure you're not screwing up on the rehab on some big item, because it will break you at the end of the day. And versus like a single family, one water heater or one HVAC unit might be, 10 grand or something like that for an HVAC system if you got to do duct work and all that stuff. But, at the end of the day, it's not going to be times 50. Yes.
Do you provide benefits to your employees?
To my employees?
Yeah.
What do you mean by benefits? Like as far as ownership of assets?
Anything, I don't know.
I'm structured purposefully with no employees. So, because I live in California and I don't want employees. Everybody's partners of mine. So, on purpose, yeah, there's really cool structures out there that you can put in place. And my brother-in-law works for me full time. My brother is my partner full time, and 90% of us are finance majors and focus in that area. But I have my own solo 401k plan, my own self-directed health savings account, self-directed IRA. There's all these different strategies you can utilize. And there's pension plans you can get $200,000-$300,000 a year into on an annual basis as well, to be able to mitigate taxes. So, okay, liabilities for direct property ownership and tenant issues. Of course, we know this, as well. And then costly upkeep of those entities, the accounting, the taxes. If you're using investor money, you have to go through and make sure that they're reported correctly, that you get the tax returns done fast, because they don't want to sit there and wait for you to do your corporate return on 3/15. They want their stuff early so they can get their taxes done. And trust me, if you have investors that don't invest in syndications very much and they invested in your syndication, they're going to be like, what do you mean you're holding me up on my taxes? You're like, well, yes, you're going to get a K-1 from this entity and it's going to flow through to you for your taxes. I'm sorry it's not done yet. You're going to have to wait till April to get your tax return done. They could be pissed. So setting that expectation with your investors up front can be, very, very big deal too, okay? And then the risk of damage and theft and things like that, same as the single family and management of those tenants and the asset management part. Same thing as single family, it's just on crack at that point, right, with multifamily. So promissory notes, another big piece. Stability of the cash flow streams, really, really key. A lot of times when you're investing in multifamily or assets, like I said, it's very volatile. You can invest in promissory notes and you just get that stable cash flow stream coming in, and there's a place for both, right? A place for the promissory notes as well as the real estate, because they provide those different benefits. right? You can get short-term and long-term notes. I really like short-term notes because the notes are not an inflation hedge, right? You don't want to sit there with a 7 or 8% note if inflation is at 15, right? Go buy non-performing notes and make 30% on your money if you're going to do that. There's a lot more work with it. You got to work those deals out, but you can make crazy returns as well. Less work due to the lack of rehab, which means less headache. Unless you have to foreclose and take that property over, then there is headache with it, of course. No tenants and termites, as long as you don't have to take it over. I'm saying this because I've had to take over properties, and you do have to do this work when you take over properties unless you just dump it and liquidate it to get rid of that asset, okay? I love this, by the way. Who understands interest rate arbitrage? It's the most awesome thing on the planet, okay? So I'm going to give you one example, and you guys are going to love promissory notes for the rest of your life, okay? So I did a $500,000 loan inside my 401k, where my 401k did the loan at a 14% flat interest rate to an investor at 65% of the value of that asset, okay? To a really experienced investor that had 20 years experience investing, and my 401k went and sold off $450,000 of that note at an 8% interest rate to one of my investors and was making the 14% on the entire thing while paying my investor 8% on the 450. If you do the math on the $50,000 I had left in the deal, that's a 68% interest rate on my $50,000 left in the deal. And that is what made me really, really excited about notes, because you can, with a couple $100,000, retire yourself on this strategy alone, which is incredible. And I do it in a whole different light, where I just borrow all of it. Instead, I don't even have my money in half of these deals. I just borrow that on the promissory notes and shift it, because a lot of investors are totally fine being at 65 cents on the dollar on their notes for that equity protection on these types of deals. So really, really cool strategy to use on notes. You can give you that proper cash flow planning as well, right? You can actually set yourself up and say, man, I need $10,000 a month, $15,000 a month to live off of. Okay, great. I'm going to get promissory notes with that, and then I'm going to build long-term wealth with everything else, right? I'm going to go through and buy real estate and all that stuff. We got 10 minutes. Oh my God, dude. Like, I am like way behind right now. Okay. So property owner usually has skin in the game, which decreases your risk also on promissory notes. And then it's always secured by the property and giving you that equity protection on that particular deal too. And then long-term servicing is much less work than, dealing with rental property directly, of course, too. And it can be freely transferable, much better than selling property. You can sell a note with a purchase agreement and a purchase and servicing agreement and a launch and an assignment of deed of trust. It's that simple. You don't even need to go through escrow to sell a note. It's pretty incredible. So some of the cons: it's not an inflation hedge. The foreclosure costs and timeline can be difficult depending on the market. You want to be in non-judicial foreclosure states, because judicial means you got to sue them to foreclose, okay? I just mentioned the non-judicial and judicial, and then the due diligence can be a little bit more difficult if you can't get inside that asset, okay? And then you want to be careful about lending laws. Do not try to lend on hard money loans in California without a broker involved. You will be in trouble. Everybody tells you, oh, go and lend money all day, but you really need to be a licensed broker if you're lending the money in California, even if it's non-owner occupied, okay? All right, next. Syndications, less work than property ownership. You don't have to qualify for the financing or do put up all the capital yourself. You can put up 25 grand or 50 grand instead. You don't have to be the full capital stack on these deals, which is awesome. Limited partners. As a limited partner, you're not carrying the liability for the partnership. The GPs the general partners are doing that, right? They're the ones with the liability. You're building that same long-term wealth. You get that same exponential growth through inflation, the same tax benefits as well, and even sometimes better tax benefits. And there's a ton of ways of making money, like I mentioned. Capital raising, finding the deals, the operations, all those different strategies you can use to actually make money in syndications as well. And it can be significant across the board, because you're usually dealing with bigger deals in syndications as well. You can still get that asset management work and the ability to diversify what I do is I invest in multiple markets, multiple asset classes, and multiple operators and diversify a portfolio with these things so that way, if one guy bounces out of the country on me or steals the money or something, I'm not stressed that I'm going to lose everything on one of those deals, okay? Some of the cons: capital needs can be much higher unless you're investing passively and you can put a smaller amount of capital in, right? The financing can be more difficult, just like a multifamily. The financial modeling can be more complex because you usually have these big financial models versus like one simple single family home. And you got to consistently give reporting to your investors. And then typically they're a little bit longer term in nature. Most of the time I see 5 to 7 year terms and sometimes 10-year terms on some of these longer syndication deals. So you're investing for the long run in these situations on syndications. And then you're giving up control of that investment to an operator that's going to do all the work. Sometimes you as an investor, you're just not comfortable with that. You got to own the deal yourself, right? So you want to be able to make sure that you are comfortable giving up that control if you're investing with somebody else. And the only way you get that is the proper homework on those different operators involved, okay? You're betting on that operator to do that work. Short-term rentals, another piece, same as long-term rentals as well, higher cash flow, ROI on those deals as well, less turnover costs because you're doing that turnover costs every single time that tenant moves out. You're actually getting them to repair those items right away. Less collection issues because it's run through the platform, right? Capital need and need for furniture is a little bit more. You're not just putting a down payment down. You got to put the furniture costs in too, because you're not going to get those furniture costs financed unless you're using like a furniture finance company, and you're not usually able to finance all of it anyways, right? More work to manage. You don't do this without a property manager in place that specializes in short-term rentals. It is a nightmare to deal with short-term rentals. You are running a hotel. You know how many times my wife got a call from someone pushing the video doorbell saying, I can't get into the unit, the keypad's not working. And you're like, I don't know how you survived life so far, but it's part of it, right? So, some of the lenders don't like the short-term rentals as well because they can't prove income as easy, so it makes it a little more difficult. And there's a bunch of additional expenses that you have to consider that you may not be. Your vacancy rate's going to be higher, the utilities, alarm costs, the landscaping, all that stuff is still there that you got to be paying for as part of it. A lot of people forget about all these costs and don't realize it and make a lot less money than they think they're going to make on these. And there's a lot more tracking that goes into this as well for occupancy and performance of these types of deals, okay? So emergency repairs, bed bugs, all kinds of crazy stuff that you have to deal with. I was telling a story earlier about how I almost got beat up by an MMA fighter because the baseboards by the trash can were dirty. You're like, really? This is crazy. And he gave me a hug afterwards and a 5-star review. And I'm like, no, you get 2 stars, dude. You try to beat me up for baseboards. What the hell's wrong with you? So crazy ass people. So platform issues, heavy marketing burden on the short-term rentals. There's a lot that goes into short-term rentals that you want to be careful of, okay? Mobile homes, same type of thing as multifamilies, but I really like it that there is an inflation hedge with mobile homes because they're the lowest form of housing that you can get. So you have people from multifamily in a down market coming down into that mobile home unit, right? So big thing there. There's limited supply associated with it as well. There's usually higher cost segregation deductions as well because if you own the homes in themselves, a lot of times you can write a lot of those off and do bonus depreciation on those too. There's a million ways to add value to these by doing improvements. The utility recapture is huge. Being able to subdivide the units into different utilities and add more units to the park and rehab those existing units. There's so many more ways than even multifamily to add value to mobile home parks. So this is why I love them. Easier to repossess. You're just evicting them out of these units. There's like repossessing a car pretty much in this case. So really big deal. Of course, the tenant base is tough. And it can be hard to find new mobile homes to put into your parks because there's a lot less manufacturers out there, right, Todd? So to do this kind of stuff, so it's not easy to find those. And a lot of cities can make it difficult to add more homes to your park and things like that as well to have problems with adding more units. Okay, and cap rates have compressed lately, just like a lot of other assets in the mobile home. So we find parks that are like 50% vacant that we can do major value add strategies with. Okay. Building cash flow strategies along with that freedom. What do you want to focus on? More passive or active investments? These are some of the things you should be thinking about when you're thinking about being passive. Do you have the time in the first place to be active? Right? A lot of people think they do, but they don't. They might be working full-time jobs and it's just too much for them. That with kids, and trust me, I have an 8-year-old and a 5-year-old, and there's no time. It's nonstop chaos, not like all day long. What activities do you need to do to be active or passive? Are you out there trying to be active where you're sending out mailers, you're grinding, you're going out to deals, you're walking rehabs? Do you have time to do any of that stuff, or would you rather be passive on those deals? What resources do you have to invest passively in the first place, right? That's going to start you off. How much monthly income do you need to be financially free? Start there. If you guys don't know that number, go put your budget together. Find out how much you really need now and how much you're going to need in 5 years when everything goes up by 10% a year in 5 years. So realize that when you're investing passively in these different opportunities. Does your current capital available get you to your goal, or what do you need to do to get there? If it doesn't, use other people's money to do that and learn how to raise that capital. How much of a learning curve are you going to have to deal with to be active? And these slides will be available. You guys can email me and I'll give you all these slides so you guys can really dive deep and think about these things in your own life. Does it make sense for you to be active or passive, or what one of those strategies I just went over seems like it fits with your personality best, right? So, or multiple of them, right? Can you deal with the risks? Trust me, there's nights that I wake up at 3:30 in the morning going, oh, take action. Oh my God, I got to freaking do this right now or I'm going to lose everything in my mind, right? Even though it's, you know, people, unless you're an active investor, you don't understand the stress that you go through sometimes on this. And sometimes it's not worth it. You're just like, oh my God, this is like causing me to have health problems and things like that in certain ways. You got to watch for that, you know? So, and know what your own limitations are personally and what you can deal with. Which strategies do you think would provide you with the most time freedom? So I would start with that too, because active investing is not the time freedom strategy. It's that strategy teaches you how to do some of these other strategies and mitigate risk, okay? Now, doing your due diligence on some of these specific operators, and how much time do I have? Like 5 minutes now, so I hope. So, okay. So these are some of the basic things every single one of you guys should know when you're analyzing any deal, okay? Any deal out there, okay? If you don't know these numbers, you shouldn't invest in any deal, period. What's the after repaired market value of that deal? This tells you what your cost versus that after repaired market value is in the first place, okay? So the cost of the project as a percentage of the ARV. This gives you your equity protection of that deal in the first place. If you don't know that number, then you shouldn't be doing the deal in the first place, okay? What is the cost breakdown of the deal, the purchase, the value add cost, the interest cost, the other costs that are involved in that deal, so you can see it with plain sight. Is there anything that's missing out of this deal in particular? What kind of debt financing is being used, and what are the terms? Look what all these people are getting in trouble with multifamily assets right now because they didn't put cap extensions on their or cap locks on their loans, where now the rates are just going through the roof and they didn't have those locks in place. How much is the property cash flow at cost? What's the cap rate at the cost? How much is the property cash flow with financing now? Not just at cost with no loan, but with the financing. So how much benefit are you getting out of the financing in the first place? Right now, not much. So because of where the rates are. Who is on your team, and do they have the experience to make sure you're successful? Whether you're investing passively or actively, your team will break you or make you. So you need to make sure that you're doing homework on that team. What are the overall risks of the deal and how are they mitigated? Think of every risk you can think of and how do you mitigate that risk on that particular deal? What are assumptions were used and why, and are they conservative? So you want to be asking active operators these things consistently to know why do they think this is conservative? Why do they think they're not being conservative? What are all the risks that they can see? If they can't name risks, do not invest with them because they're lying to you. There's risk in every single deal that you do. What is the estimated timeline to get it to completion? What is the exit strategy of the deal and the backup strategy? If you can't go sell that deal on a fix and flip, how much is it going to rent for? What's your backup strategy there if you had to rent it, right? What are the incentives for performance? Is the operator you're working with, or are you doing the deal? And how are you incentivized for performance on that particular deal? Are you make all your money on the back end and don't make a lot up front? There's major incentive for performance. Do your investors get paid first, which they should? Are there enough cash reserves? I can't stress enough this cash reserves piece of this. It is massively important and will reduce your stress across the board. What markets is it in? And back up all the numbers with due diligence. Every number in their financial projections, you want to ask them, how did they come up with that number? What's the justification for that number? And do you agree with that justification in the first place? All right. I'm going to go through this very quickly. Background check, incentives and track record. What are the asset classes that they're experienced in for operators? Do they have bandwidth to do more deals? A lot of times people take on more. I've done that in the past myself. What does their financial reporting look like? Do they have the knowledge to understand what's actually happening in the market, right? Who's their operations team, the underlying support staff that's doing that work? Who's their managers, their contractors, their realtors, their attorneys? Understand who they are and their experience with the deal. There's a significant amount of homework you should be doing as an operator when you're, or as a private investor if you're investing with someone else. But if someone's investing with you, you better know these things about yourself, because you can say, hey, investor, this is how you do the homework on me. Here's a list of things I ask every other investor. Here's my answers for me. This is what my answers to these questions, okay? So is this deal structured with performance-based incentives in place is key, of course, and is it structured regarding how is it structured with regard to the legal documentation? You're gonna be going to sleep reading some of these syndication documents and things like that, and get an attorney that can explain those things to you. Very, very key, okay? So pros and cons of being an active investor, this is my last slide. Learn how to add value to investments and control your financial future this way through specializing in a specific asset class. That's one pro. Create active income streams to boost your available cash flow and invest passively. I'm going to just click through these because it's not working. Make money by adding value using your knowledge. And then, of course, the cons, you're still trading your time for money. It can be capital intensive, stressful, there's learning curves. There's a lot that goes into being an active investor. And then the pros of being a passive investor, you don't have to do any of the operations work. You don't have to qualify for the financing, and you can get high returns just as much as you would being active by investing with the right operators as far as putting your time in and having to trade your time for money on those situations. And you can build that diversified portfolio for yourself as well in these strategies. And the cons are obviously you're typically giving up the control to that outside operator that's going to do the work for you. And you have to do a ton of homework up front on these deals to make sure that you are protecting yourself across the board, okay? I'm not going to go through this. The point is taxation is theft, okay? That's the point here. So there's a lot of ways to mitigate taxes and doing a ton of different strategies as a real estate investor that you guys can have, and you guys can see these slides later on, and I'll send these to you guys because I'm running out of time. I thought that was the last slide. This is an IRA slide showing, normally this takes me like an hour and a half to get through this, but obviously tonight I don't. Using your self-directed retirement accounts is one of the most powerful ways to build wealth inside your retirement accounts. You got to watch out for some taxes on the UDFI and the business income tax as well. And you got to make sure you're finding the right custodian and make sure you don't do business the wrong way. No lineal descendants, parents or kids or anything like that you should be doing business with. You can do business with aunts and uncles and cousins all day long, or friends all day long. You just can't do business with lineal descendants or business partners that are closely held, okay? So diversity, operating partners and asset classes. You can invest in direct owned assets and passive cash flow investments through syndications. And these are some of the reliable long-term methods to invest in real estate, protecting your long-term wealth through those inflation hedges in different ways, not just promissory notes or not just property, properly managing your investments and constantly reviewing your return on equity in those current investments that you have right now. Really, really key to being able to successfully do this long term. I also like to invest in some insurance company type things, insurance like things like gold and silver and commodities and stuff like that in case real estate takes a giant dump. I even own a marijuana farm and things like that and all these different things to create cash flow in these different ways. So really good strategies. Here's some free resources for you. You guys can scan my QR code if you guys want to, and you guys can follow me on YouTube. Here's my social media links. You can find all this at MatthewOwens.com as well. We also have different affiliate programs and stuff like that as well. You scan that QR code and you'll get all my contact information, and you can email me and I'll send you these slides because I had to go crazy fast. I'm sorry I tried so hard to get through that. It's 5 minutes before 9, so I'm sorry for that. But thank you so much for the time today, guys. So I didn't realize how